Good morning, all. Yeah, I've been away. Yeah. My winter break. Take my 64-year-old bones out this country to try and warm them up a bit. Anyway, I'm back. It's a shame the weather wasn't like this over the weekend. Gosh, look at that bright sunshine here in North Buckinghamshire. Yeah. Anyway, what's been going on in the markets? Well, I've been following them from afar, and just astonishing some of the numbers coming out in the US. I don't know whether that employment data, not Friday gone, the previous Friday. I'm probably talking about stuff that it's gone and dusted now, but just extraordinary how strong the US economy is. We've got GDP readings here in the UK for our fourth quarter, and they're pretty rubbish. If anything, we're going to be in a technical recession, like the Eurozone, actually. And in the US, it's just such a different story, isn't it? But a week of records. Who can tell me what the record was in the States last week? I'll give you a little bit of a clue by putting up a little chart. Go. So that's the S&P 500, which is the Standard & Poor's 500, the top 500 shares in the US by market capitalization, i.e. their value. No one's prepared to say. What about in Japan? I used to trade Japan way back in the 80s, and I remember they actually have hit their highest level in Japan now since December 1989. That's a 34-year high. I got to say, I remember the sort of busy days back in the 80s, and everyone was trading Japanese equities. They were just absolutely flying. And I think even as I saw them fall, I didn't think it would take 34 years before they actually recovered the position, but just extraordinary. And they've got a lot of fans now, Japanese markets. Warren Buffett's invested heavily in some of the trading houses there, and other big fund managers have made a big point about really rating the Japanese market. And last week, it was all helped by the Japanese yen, a weaker Japanese yen. This is the number of yen to the dollar. So a higher number means the yen's weakening. And that's down to the fact that the Japanese central bank, the Bank of Japan, are not going to be altering their monetary policy anytime soon, which at a weaker yen, it helps Japanese equities. Why? Well, all those big exporting companies in Japan, they are a lot more competitive as the yen weakens, so enables them to earn more and more foreign currency, which eventually is swapped back into yen, but for the time being, really helping the Nikkei for sure. US equities, if I may, all-time high. Thank you, Owen. New highs, Jeff. Yeah. I think we all know anyway, don't we? US equities reached record highs last week. The S&P 500, which I'm not showing, I am now. The S&P 500 breached through that psychological 5,000 level. I remember trading S&Ps when they were 260. Yes, less than 1,000, less than 500, and we used to trade them in, quarter of a point, and a quarter of a point was a big move. Gosh, nowadays it goes up and down like nobody's business. I mean, the S&P 500 was up nearly 70 points last week. Extraordinary. When a US election year, usually markets go up. That's interesting, Ern. You are right. Statistically, they do. Statistically, the dollar rallies in January. Statistics, they tend to work quite well. But as Churchill said, statistics, damn lies and statistics. Anyone can use statistics to bolster an argument, is basically what he was saying. Anyway, S&P 500 breaking through that 5,000 level, an all-time high, but the market breadth was lacking. For those of you who are not sure what market breadth means, it basically means there are not many shares that are making new highs as the index makes record highs, which is a bit of a problem for the markets. What's driving the market higher are the super 7 tech stocks, as they're called, and these are the tech stocks that have propelled the indexes the Nasdaq and the S&P higher last year, and it's the same thing so far this year. Whilst the S&P 500 has gained 5% so far this year, most equities have not seen those sort of gains, because basically down to the fact that the Federal Reserve has disappointed the wildly optimistic view about the scale of rate cuts this year that the Fed is going to deliver. And I think that process of readjustment we are still going through. And you might say, well, hang on a second, Jerry. So you're saying the conditions aren't good for equities and yet the market's hitting an all-time high? Yeah, I think it's just what's propel the market higher is the fact that these tech stocks, which don't borrow money, they've got huge cash piles, and it's the smaller stocks that are really struggling. But if you look at the likes of Nvidia, this is that chip maker that hit the headlines this time last year. Their new chip that was, I can't remember what it was called, but costing 44 grand, I seem to remember, and it was designed for crypto mining. They suddenly realized that it got a great solution for AI. So the AI boom has really benefited Nvidia. And Meta, just astonishing results. Was a couple of weeks ago while I was away. Anyway, the Meta has just jumped significantly. And I think Nvidia and Meta are both up 30% so far this year. We're only on the 12th of Feb, 30%. We're talking about hundreds of billions of dollars, and it more than offsets what's happening in the broader S&P 500, where only half of the S&P 500 constituents have risen this year. So half of them haven't gone up at all, and are down. Yeah. But it's interesting expectations. As Owen said, it's an election year and the markets tend to get a bit bulled up about the prospects for an election. And gosh, you just look at what's coming around the corner with Donald Trump and just listening to his comments about NATO, you just think we're going to have to go through 4 more years of that. Maybe he's going to be good for the US. Maybe it's not our business. We don't have a vote. Maybe we should just shut up and let them get on with it. But we can have an opinion, I guess. Anyway, this market breadth is a bit of a concern. The Russell 2000, if you've heard about another index, this is an index that tends to have the sort of smaller cap stocks in the US. And what's interesting is that the Russell 2000 is a long way off its highs, which it achieved in 2021. And a lot of the stocks in the Russell 2000 are struggling due to the fact that they've got lower profit margins, and also the fact is they tend to borrow money, and the higher interest rates are affecting their profitability. And obviously the increasing belief that rates won't fall as predicted, at the start of the year. Conversely, as I said, super tech stocks, these super 7 tech stocks, they've got huge cash piles, which sort of effectively insulates them from the interest rate debate. Actually, doesn't just insulate them from the interest rate debate, they actually make more money out of it. Anyway, there we go. Right, what else is happening? Dollar, dollar was always destined to rebound, wasn't it? Following the realization that the markets had got far too dovish on interest rates. What I mean by dovish, the markets were expecting interest rates to fall significantly, whereas the Federal Reserve made it very clear in their dot plot that they were only expecting rates to be cut 3 times this year. Anyway, the market had expected a cut in the March meeting on the 20th of March. If you hover over this, where interest rates are at the moment, 5.25 to 5.5. A month ago, there was a 19% probability that rates would be here in at the Fed meeting. Well, guess what? It's an 82.5% probability now, and the probability of a cut down to 5 to 5.25 band. A month ago, the probability was 77%. Well, guess what? It's 17% now. So that's that readjustment. So the markets have come more in line with what the Federal Reserve is thinking. And as we know, interest rate expectations is what drives a lot of moves in foreign exchange. And I think the final nail in the coffin was the astonishing non-farm payroll or unemployment data release that we had. It was the first Friday. Yeah, that was it. The first Friday I was away. I mean, I saw this data and I honestly thought it must have been a misprint. But it really is a huge number, a number that can't be, even if it's wrong by sort of 50,000 jobs, it's so strong. In effect, the aggregate number of new jobs reported in January was 353,000, expected 187, but they also upped the amount of jobs created in December by 117,000. So that's 470,000 jobs, far exceeding 187,000 forecast. Anyway, any lingering expectation of a rate cut in March is off the table, as we've just been seeing. The euro, well, we can see that the euro started the year somewhere around 110. There we go, 110 start of the year. And of course, interest rate expectations aren't just what interest rates are going to be doing in the US. What about the Eurozone? There we look at that, and then we just consider Germany and Italy continuing to struggle, and the broader Eurozone economy is clearly stagnating. The calls for cuts in the ECB official rates really do grow louder, and I noticed the governor of the Bank of Italy calling for a rate cut, and I know the Bundesbank, who tend to be quite conservative in that regard, are suggesting that the rates will soon have to be cut. So that really is playing into the hands of a stronger dollar versus the euro or a weaker euro. And so it's not surprising to see it fall off those levels from the beginning of the year. Commodities, just very quickly, gold. Well, gold just tracks what's going on in the dollar and global macro events. So you've got the strong dollar on the one hand, negative for gold, and then you've got the escalating conflict in the Middle East and the fact it is escalating to a certain extent. I know the US and Antony Blinken have been trying to ensure that it doesn't, but it just sort of has that inevitability about it in a way. Anyway, I think the oil markets reflect that more accurately, and as you can see, oil rebounded, recovered all the losses from the previous week, up $4 last week. So that's what, sort of 5.5%. So interesting to see just what happens this week, and this attack on Rafah that the Israeli Defense Force have signaled. Okay, let's have a look at the calendar. You're okay for here? Everyone listening intently? Gosh, it's good to be back. Good to exercise the brain. Anyway, so where are we? Let's get the right calendar. Let's get the right month. Let's get the right week. There we go. How does crypto affect gold? See, that's really interesting. That's a very good question. Crypto has become the sort of lightning rod, one of the lightning rods for global macro events, like gold used to be, and a hedge of inflation in a sort of roundabout way. Do I think it's something that will last? I don't really know. I'm not a great fan of crypto myself. The technology, blockchain, yes, but not the crypto assets generally. But yeah, you could say that crypto actually tends to lead gold, but gold has been really bolstered by central bank buying. In particular, the People's Bank of China is responsible for about 70% of purchases over the last 9 months. So they are the ones pushing it. But the speculative element, I suspect, will be anyone who's long of gold and has been long of gold for a long time, anywhere above $2,000 would be quite tempting. Just remember, gold, you don't get a dividend. You don't get any benefits whatsoever. You have to pay to insure it, and you've got to pay to warehouse it. It's an expensive trade. You can only make money if someone buys it off you at a higher price. And interest rates going up and staying higher for longer also has an effect on gold because of the financing costs. So it's the opportunity cost of holding gold versus putting your money on deposit. Okay, so we got the Lunar New Year celebrations. Chinese markets are actually closed for the whole week. That's mainland China. Hong Kong, which is somewhere I've got a little bit of knowledge, I know is closed. I think the markets reopen on Wednesday, so they don't shut all week like in mainland China. And it's the year of the dragon. There you go. Strength, apparently, is what the dragon's about. And yeah, so they got 12 signs of the zodiac. They're different to ours. We don't have dragons in our zodiac. At least I don't think we do. Anyway, so first on the discussion, Andrew Bailey. There's quite a bit of data coming out of the UK this week, so it's probably worth just sort of listening to what some of these, or our head of the Bank of England is saying, the governor of the Bank of England, Andrew Bailey. He's speaking in Loughborough University. And I think it will be interesting to hear his comments ahead of the GDP data, where we're possibly likely to be in a technical recession, although I think we're going to perform better than some of the pundits expect this year. And that's not just, I'm not just hoping that. I think that's, we tend to attract some pretty bad press and a lot of negativity, and I think that there are some signs for optimism. Anyway, the GDP data is a lagged reading. It's telling us what had happened in the fourth quarter, which is October, November, and December. And December wasn't a great month, was it? Things really ground to halt. So I think it's possible that we will have a negative reading. And two quarterly negative readings actually is the definition of a recession, a technical recession at least. Okay, Tuesday we have our UK employment data, claimant count and average hourly earnings for January. So sterling will be sensitive to that. I won't go into any more detail about that. The more important data release on Tuesday is the US inflation reading. Headline inflation expected at 2.9 is the headline reading there versus 0.2% monthly. The core rate, which is the one that excludes the volatile components of energy and food, and you think, wow, why exclude energy? That's the reason why the whole thing has gone up in the first place. Well, it tells us what the underlying rate's doing if you remove those volatile components of energy and food. Anyway, this rise of in the core rate of plus 0.3% will be the third rise in a row, but expectations are for inflation to moderate again by spring. So dollar and US assets will be particularly sensitive to this, because this can affect US Federal Reserve policy, although they tend to follow the PCE data more than the actual CPI data. Wednesday, we've got our own inflation data here in the UK. Headlines expected at 4.1%, and that's down to the base effect of last January, where inflation fell 0.6%. So that's falling out. So that, even with a decline in underlying prices, the year-on-year reading is actually higher, if you get my meaning. Anyway, expectations are for further downward pressure by April in the headline inflation rate here in the UK, and that's down to the rapid increase in inflation last sort of between February and, I don't know, whatever it was, June. And as those fall away, the yearly headline inflation rate will come down, because it's not affected by those months where inflation was going higher. Okay, Wednesday we've dealt with Andrew Bailey. He's speaking again. He's testifying before the Economic Affairs Committee in Parliament, and that can be quite lively. So Sterling might be on watch for that. We then jump to Thursday, and again, more UK data. It really is a month for UK data. So this is the growth gross domestic product. So you've got two readings. We never used to release monthly data, only quarterly data. Obviously, every month we do release monthly data, but the monthly data makes up the quarterly data. And it's the first reading of the fourth quarter that we're interested in. And again, it's a bit of a lagging bit of data because it's told us what has happened. Nothing is going to change this data. It's interesting to know what it is. And as you can see, we're expecting a reading of minus 0.1%. And yes, with that being the second quarter of negative growth, technically the UK will be in a recession. And I sort of think, well, does that change things much? We know that growth has stagnated. But I guess it will ramp up pressure on politicians and Rishi Sunak, and in a week where I think we've got two by-elections, so that's something that may be a bit thorny for the Conservative government and Rishi Sunak. We then got Christine Lagarde, chairperson of the European Central Bank. She's testifying before the Committee on Economic and Monetary Affairs in Brussels. So the euro will be sensitive to anything she says. And then we have US retail sales. Actually, quite a bit of data out this week, and it's the core retail sales we like to look at. That's the one that excludes transportation, specifically cars, which really can affect the reading too much. It's too dominant. So they remove that and they have a core retail sales reading. It's nothing much to write home about. We've then got the Empire State Manufacturing Index. The manufacturing sector in the States is bigger than ours here in the UK as a proportion of the overall economy. And it's struggling a bit like our manufacturing sector, in fact. And when you look at the Empire State, which is the New York State, referred as the Empire State, you can see that it really is struggling below the zero line. That reading last month was just almost looks like an aberration. Anyway, but I think despite the huge jump in new jobs that we discussed back in January, which was reported at the beginning of Feb, the manufacturing sector, yeah, it just is not picking up the way perhaps some economists were expecting. Friday, we then go to our own retail sales here in the UK. Bit of a rebound. Retail sales were horrendous in January for the December period. And I think that was all affected by Black Friday, which brought sales forward to November last year. Anyway, it is horrendous, or retail sales have been horrendous, but that 1.5% rebound, I don't think there's anything much to write home about. It's just a rebound from the really dire number the previous month. Sterling will be sensitive to that release. And then PPI, this stands for the Producer Price Index. This is not something that's followed that closely, but it is like a precursor to inflation, and it's the cost of goods going into production. So if you've got higher input prices, then it follows that the output prices will go up as well. So that's something that the economists do keep an eye on, but it's fairly benign for the time being. And then finally, for the end of the week, we've got our first reading. In fact, the only reading we care about. They never seem to make any changes to the prelim when they release the final reading. But this is the prelim University of Michigan Consumer Sentiment reading. Very happy consumer, as you will see from this chart, getting happier and happier by the month. And probably down to the fact that their view on inflation is coming down. So with falling inflationary expectations and happier consumers, markets, do they lead or are they being led? To a certain extent, I think happier consumers lead to better markets, but you can't think you can get much better markets than what we've got in the US, although, as I said, the market breadth's not brilliant, is it? Anyway, that's it. I've whittled on, but I've managed to get through this by 10 past 9. I don't know what that means. Probably means I've been speaking quickly and not been answering any of your questions. Yeah, a lot of economic news, actually, but it's sort of interesting because I'm refreshing a lot of the stuff that I hadn't really dwelt on whilst being away. But I hope it's proved helpful. Any other questions, let me know. Otherwise, we'll end today and I'll be with you again next Monday with Stuart. to go through the same again. Thanks very much, and have a good rest of the week. Yep. Bye for now.